Yes, welcome everyone once again to this most exciting and most interesting session on my international tech series, digital economy. And it's so good that I think consistently we have been getting about 1,000 people on this. So it's a great interest. I think it's one of the largest, attraction in the international tech arena. And obviously, that's all due to the speakers like Daksha, Baxi, and Guglielmo, Maisto from Italy, which are very, very leading authorities in India and in Italy, respectively. And we are lucky to have them with us. In fact, Daksha worked with me for a number of years, and I've known you for ages now, and it's so exciting to be discussing the very hot topic and the current topics and the latest things in and around digital economy, because the whole world has become digital now, and more so during this pandemic. Everybody is now digital, so you do not know who is where, and how they what are they doing, and the process where the source, where the residence, and so on and so forth. So I think in digital economy, a lot of IT and other issues also come up. And today we are going to have discussion on this. We have Dhruv Sanghavi, who is again my buddy, and he's my junior, and again he's a top academics in Netherlands now, and we are lucky to have him, and he is the brain behind the Imaginarium, and we are very happy. And again, I cannot forget Parul Jain, who is the leader of our international tech team, and based out of Delhi, and will be moderating this session. So welcome everybody once again. I don't want to take too much time in introduction, but I thought I'll just welcome you and then we'll move forward. So over to you, Parul. Thank you.
Yeah, thanks a lot, Nishith Desai. And I think, before we really start, the session, I just wanted to, and actually I was remembering, when I was reading all the controversies with respect to taxation of the digital economy. Nishith Desai was actually a pioneer who came out with, his thinking on how digital taxation should work. And there was a 2002 Ecom Taxpert Group report, which Nishith Desai had pioneered. And in fact, in that report, and this was in 2002, and we are 18 years down the line, where taxation of digital economy is still such a big issue and it's getting bigger by the day. That report actually said that, the group of people who had come together, they believe that India should not rush in creating unilateral changes to taxation of e-commerce transactions. And, there should be a consistent approach which needs to be followed. And this consistent approach is really going to be the solution rather than forming any unilateral measures. I think what has happened over the last few years is exactly the opposite. We have had, quite a few unilateral measures, with the equalization levy, first on advertisement, digital advertisement, then the significant economic presence. Then we saw another form of equalization levy in a different avatar that was introduced, with the passing of the Finance Act 2020. But we'll talk about those as we move along. I think the other important thing which is happening globally and which is more of a concern is that, with the COVID impact, economies are looking at implementing unilateral measures in a hurry, in a kind of a rushed-up solution. OECD has come out by, reinforcing its commitment to solve and to finish the work on the digital taxation by the end of 2020. And there is a concern as to whether, with all the unified approaches happening and with the, crisis which is going on globally, whether, multilateralism is going to be pushed back by most of the economies. And it is really going to be a job to have consensus among 140 members and get them within the inclusive framework which OECD is proposing. But what I'm going to do now is that, I'm going to hand over to our esteemed panelists. As all of you would be aware, they have generously contributed chapters on this issue to a book which has been presented to Nishith Bhai. And they will first, talk about what their chapters are about, and then we will move on to a panel discussion. Nishith Bhai, you want to make a point?
Yeah, I think, I had forgotten that we created a very famous expert group in 2001. And I must say that Professor Klaus Vogel was a part of that. So we had all the top intellectuals and thought leaders in international taxation with us. And we still miss Professor Klaus Vogel, who was like a father figure, and I learned so much from him. And let us dedicate today's session to Klaus Vogel. And with those words, let us have Daksha, or who is going Maisto, or Daksha is taking the presentation? Okay.
Right.
So please carry on.
Daksha, over to you.
Okay, thank you.
Yes. Good evening and good afternoon and good morning, depending on where you are. I am delighted to be part of this panel discussion. It's a wonderful thing for me because just as Parul and Nishith alluded to, this was the beginning of my introduction into the taxation of digital economy. Of course, it started in 1998, but it is very interesting because I was part of one of the first electronic commerce transactions dispute that had arisen in India in respect of the computerized reservation systems. And the journey started from there. We then, I've talked a lot about that part in my paper and how it all started. So what I would do is, without making too much other discussions, I move to my my presentation, because what I've done is I've set out the issue of the that is being faced by the world as such, in terms of the fact that why we have this issue and why we are in the need of finding a solution. And as everyone is aware, we are all moving towards more and more digital economic transactions. COVID-19 is more or less forcing us to move into that direction. So this is going to be an extremely important aspect of international taxation. And we all need to have a very good understanding of the fact that it is going to be very important for the market jurisdictions as well as the residence jurisdictions to be aware of how to share the tax revenue arising from this. So, and just quickly moving to what the issue is, I've just put out here on my slide, on the right-hand, the bottom corner, you see a customer sitting in country S. That customer is doing online booking with airlines and hotels and all the transactions that it needs to do in respect of international travel and making the payment to these entities. These entities do actually the booking through a server which is located in country P and pay a fee for the use of the server, and then the entity which is receiving this payment in country P is making payment to a company situated in country R, which owns the intellectual property in terms of the software and hardware, and that is situated in P. Now, what happens is, though the revenue by the company in country R is earned from the customer in country S, no part of that revenue is subjected to tax in country S. This is one example of a transaction. There are hundreds and thousands of transactions, permutations, combinations that we can think of, which is causing the problem for countries in the situation of country S, where they want to have a piece of tax revenue arising out of the revenue earned by country R. So what is the journey so far? We started, as I mentioned, in 1998. There was an Ottawa Ministerial Conference on Electronic Commerce. Then the OECD set up a technical advisory group, which came out with one of the last reports it had on characterization of transactions, 28 categories of transactions it had analyzed. And each type of transaction they analyzed whether the income is in the nature of royalty or business income and where it should be taxed. At the same time, India, that was the point when Nishith Desai stepped in, creating this taxpert group, because India had come out with the categorization of second category, which was the transaction in the nature of bundled software, and the payment for that, the shrink wrap software as it was known, payment for that was characterized as being royalty in India, whereas it was not characterized as royalty but as business income in the tag report of the OECD. So that's when Nishith Desai set up the taxpert group. And virtually in those days when we did not have the technology so advanced, we still were able to come up with a wonderful report which was presented. Of course, the journey has been tremendously, thereafter there was a lull, there was a time lag. India was always very, very concerned about how it can take a piece of the revenue out of this kind of transactions. And we have a plethora of cases in India where the Revenue Department always tried to bring it within the Indian tax net, but the judiciary upheld the principles of international taxation and the treaty interpretations. And in most cases, the revenue did not succeed. But of course, the litigation continues to be there. Then the base erosion and profit shift, the whole initiative started in 2013. And the OECD came up with the base erosion BEPS action plans. And Action 1 in the 2015 final report addressed the challenges, tax challenges of the, or articulated the tax challenges of digital economy. Then came, the work had been going on, and then came an interim report in 2018 on the tax challenges arising from the from digitalization of economy. And then in 2019, there was this public consultation document on the unified approach to approach under Pillar 1, which is really at the moment the base document that we are going to be talking about. But even in 2020 January, there is a whole document which has been put out by the OECD on the Pillar 1 and Pillar 2 approaches to address the tax challenges arising from the digitalization of the economy. The final report of 2015 by the OECD had kind of looked at bringing the digital transactions within the source, within the tax net of the source country in with three different approaches. They were just approaches which were out there, put out there for discussion purposes. Equalization levy, significant economic presence, and withholding tax on digital transactions. As I said, India had been really wanting to tax these transactions. So as soon as this report was out in 2016 in the Finance Act, the Indian government came out with an equalization levy. I believe India was one of the first countries to bring out the equalization levy. Of course, it was limited only on the offshore advertisements, but it was there. 6%, significantly high levy. It's still there. The interesting part is that in 2020, Finance Act 2020, Parul alluded to, India has expanded the coverage of equalization levy to other transactions, e-commerce transactions, where the e-commerce operator has more than 20 million rupees worth of transactions happening in India, and the levy is 2%. It's quite interesting. We don't know yet as to how this is going to be actually operative, because it is more or less like an extraterritorial tax. How will it be recovered, etc.? It's an interesting piece of legislation that one needs to read and look at and wonder how it's all going to be implemented. In between, in 2018, India also introduced the concept of significant economic presence test in its domestic law, which wants to tax the significant economic presence is created if receipts from sale of goods, services, electronic download of digital goods, etc., exceeded a threshold amount, and that threshold amount is yet to be prescribed. In other situations, if there is a systematic soliciting of business in India digitally above a threshold number of users, then also significant economic presence is created and it is to be taxed. As such, this provision has not been operationalized. In fact, in 2020 Finance Act, there is a specific mention in the memorandum that this has been postponed to be operationalized only after the OECD finalizes its unified approach under the Pillar 1 and Pillar 2, which is supposed to be taking place at the end of 2020. So if we see around the world, if we look around the world, there are a lot of countries which have sort of come out with some sort of tax on digital economy transactions, but majority of the countries have used the method of levying indirect tax. So there is a digital service tax which has been implemented by countries like Czechoslovakia, Czech Republic, France, Italy, United Kingdom, United States of America, New Zealand, European Union. GST has been implemented by Singapore. Service tax on digital services is provided by Malaysia. Significant economic presence has been also promoted by the European Union. India is already, of course, pioneer in that. India has also levied equalization levy. And most interim measures that most of the countries have set out are stated to be reversed once the Pillar 1 provisions are finalized and implemented. However, unfortunately, we don't see such a statement being made under the Indian provisions. I assume that they are going to be reversed or they are going to be aligned with what is the Pillar 1 approach that is finalized, but that statement is not there in Indian law. We now go to the next slide. I don't want to talk about this. It's really just saying where we are in terms of the timelines. It's already presenting what it is and where we are. End of 2020, we are expecting the final report. So what did the program of work of the OECD set out? It talked about two pillars: an inclusive, unified approach to address the tax issues in digital transactions, Pillar 1 is supposed to be focusing on allocation of taxing rights, and it undertakes review of profit allocation and nexus rules. Professor Maisto will be talking about that in more detail, so I'm only going to leave this principle before all of you. I just move on to Pillar 2. What does Pillar 2 focus on? On the remaining BEPS issues, and it intends to develop rules so that the state of residence has a right to tax back a multinational enterprise if its overall tax rate is less than a prescribed threshold rate. This seeks to address the tax planning. We assume that it seeks to address the tax planning techniques used by the multinational enterprises. The Pillar 1 concept of determining a part of profit which is to be subjected to new taxing right has a routine profit and non-routine profit, and it is the non-routine profit which is going to be allocated to the user participation, marketing intangibles, and significant economic presence, whichever way we are looking at it. So what could we expect to be included in this, and what could be excluded? It is more or less intended that business to customer, B2C, sale of goods and services will be included. So the transactions in that arena will be included. Sale to third-party resellers or intermediaries will be included. Intermediary products and components acquired for personal use by customers will be included. Licensing rights over trademarked products over brand like franchise will be included. What will be excluded will be the intermediate products and components incorporated into a finished product. Extractive industries such as mining, agriculture, and forestry products will be excluded. Financial services and insurance will also be excluded. And operation of ships and aircraft in international traffic. So these are the expectations with regard to what will be excluded and what will be included. I now invite Professor Maisto to talk about the actual Pillar 1 provisions, because through them, before I move on to sort of concluding as to what I see to be the panacea of taxation of digital economy. Professor Maisto, over to you, please.
Thank you very much, and thank you for inviting me to this webinar. And yes, the Pillar 1 project is a very ambitious project that the OECD has undertaken. It was equally ambitious, the project of BEPS, when it started, and I had doubts at that time that it could materialize in something real, but I was wrong, and indeed the multilateral instrument did show the power of and the persuasive power of the OECD in getting countries to agree to a result. Although for the multilateral instrument, if we look at the possibility for the OECD to put together countries to agree on something, if we look closely at the multilateral instrument, we see that we only have two provisions which constitute a minimum standard, and on all of the other provisions, countries had the freedom to basically opt in, opt out, present reservations, and so on. So we have a variety of situations and approaches by the several countries. So a level of flexibility that basically contributed to the success of a multilateral instrument. Now, if we look at the Pillar 1 project, I don't think that the Pillar 1 project, which aims at an allocation of taxing rights between the source state and the resident state, so reconsidering entirely the concept of source taxing rights, I find it difficult to have the same policy that the OECD adopted for the multilateral instrument with several options. Because options, when you allocate taxing rights, basically would not work because they would lead to double taxation necessarily. So that is the reason for which I believe that the Pillar 1 project is an ambitious project and which shall actually require all countries to reach an agreement. That would mean to basically redesign new nexus rules, move away from physical presence, and design new profit allocation rules. Apparently, on the principles, a general agreement was reached, which basically was turned into the policy note in January 2019, which is based on user participation, marketing intangible, and significant economic presence, which is less than permanent establishment. But if we move into the technicalities, so if we move from policy to actual rules, namely the way the Pillar 1 could actually be converted and translated into legislative rules, because at the end of the day, once the whole discussion shall be over, each country shall need to have rules which shall tell taxpayers how to apply this principle. So we cannot stay high in the discussion. At some point, we need some practical rules which indicate literally how to apply the taxing rules. Now, if we look at these rules as they have been designed in terms of principles by the OECD in the policy document, as it was mentioned earlier, income will be allocated between souls and residents on a different basis. Basically, we would abandon the concept of a physical presence, and profits will be divided into three categories, as it was mentioned: amount A, which would include the residual profit based on a formulary approach, and amount B on the routine marketing and distribution functions, and an amount C on additional profits for functions exceeding routine marketing and distribution. Now, what are the issues which are evident and which countries need to consider? First of all, I would say is the business which is included into which the Pillar 1 concept would apply. Originally, it had to be the digital business, and in the Pillar 1, there is a broader scope. Reference is made to consumer-facing businesses. But even if one were to apply the Pillar 1 concept only to consumer-facing businesses, then we have a number of issues which need to be addressed. The first one is the situation in which within one group we have two activities: one, business to consumers, which will be subject to the new approach, and another part of the business, which is business to business, which will be excluded from the Pillar 1. So you need a segmentation between the two lines of business, and that is something which technically may present issues of application. Another issue that we may face in practice is the situation in which the group is using in the source state local intermediaries. Taking into account that the Pillar 1 remunerates marketing and distribution, and that allocation criteria no longer works if distribution and marketing is in the hands of independent parties, so special rules will be needed in order to cope with such situations. Second area would be the nexus. We would move away from physical presence, as I said, but in order to have such territoriality rules, such redesigned rules to be applicable, then one would need to rewrite domestic law. So there is a need to amend and review domestic law rules, and there some countries might face constitutional problems insofar as some businesses might be included, some businesses might be excluded. Is there a discrimination which violates equality principles, which will be bound by domestic law in some countries? We are familiar in Europe and elsewhere with certain businesses taxed more heavily than others, and in some situations, both special extra taxes have been found unconstitutional because they discriminate between different classes of taxpayers. That is an additional issue that needs to be addressed. A final point, I don't want to take it too long and so also have and allow time for questions. Another important issue is the determination of the income, taking into account also on the transition from the old rules based on physical presence and the new rules. I give you two examples. One is the situation in which one group is incurring losses for a number of years, and such group does have prior year losses which might be used in the future. If that group is going to be subject to the new rules under Pillar 1, would the losses be wasted? They should be used to offset future income, but obviously they have been determined according to the old rules. And how can we make them applicable to the new Pillar 1 rules? That is one issue. Or you may consider situations in which fixed cost investments have been made in prior years with long-term depreciation over a number of years. That again might create problems when the new Pillar 1 rules come into play because they would create frictions. These are just two or three examples of issues that countries would need to address. And so I believe that the OECD shall not have an easy life in putting all the countries together with a limited room for flexibility, because options, as I mentioned earlier, are hardly available in a new design of the territorial rules, which requires plurilateralism and not bilateralism. So I think I stop here, and I'm obviously ready to reply to your question. Thank you.
Yes. Thanks a lot, Professor Maisto. I think you've raised some very valid points, and at least, from an Indian context, when one thinks through all of these points, a few more issues start cropping up in our minds. But what we will do is that we will jump straight into our panel discussion. And Daksha, I'll start with you. And, I think let's talk a little bit about what India has done and the new equalization levy, along with, the SCP provision. You mentioned in your presentation that the SCP has been deferred by a year. And the reason for that was primarily because, OECD is expected to wrap up its work on the digital taxation within this year. But at the same time, we saw that there was a kind of a backdoor entry to another digital tax in the form of a new equalization levy. And this equalization levy primarily applies, to e-commerce companies. And the nexus which is getting created is primarily, any sale of online sale of goods to a person resident in India, or in certain circumstances to a non-resident, or if someone is using, an internet protocol address located in India. Now, when I look at, the earlier e-commerce report, when the equalization levy was first introduced at the 2016 e-commerce report, which was issued by a committee set up by the Central Board of Taxes in India. The committee had, justified itself by saying that the time is right for introducing an equalization levy. And primarily the reason for that was that, it felt that the allocation of taxing rights between the state of residence and source will lead to difficulties in agreements, and it may be very difficult to arrive at a consensus with respect to attribution of profits. It had also agreed to defer the SCP till the time some sort of a consensus was not achieved. Now, when we look at the new equalization levy, and, there are questions which are being raised with respect to its constitutional validity. Is there really sufficient nexus with India, given that, it's with respect to sale of a product to a resident in India? It's not really necessary that the resident needs to be present in India. The resident could be present in any country, while he's interacting or purchasing goods from an e-commerce operator. And also what really perturbs me is that, when we look at the entire unified approach under Pillar 1, and, Professor Maisto talked about how, losses need to be taken into account of global enterprises, how we need to take into account the capital investment. But is this really then, the introduction of the equalization levy at this stage, that too without any background papers, without any memorandum of, to explain the intention as to what is getting covered? What are your views on this, and how do you really see this tying in with the unified approach under Pillar 1?
Okay, so in the first place, the approach is not completely outside the unified approach action plan. The reason being that we've already seen that those approaches are talking about this kind of tax. So it is intended that this kind of tax may also be considered. But as regards the equalization levy, especially in the manner in which it has been introduced in the Indian law, and mind you, it is not even part of the Income Tax Act. It is a separate chapter under the Finance Act. So there are issues, and we just talked about it yesterday also, whether equalization levy will form part of double taxation avoidance agreements that India has entered into, whether the definition of taxes covered under tax treaties would cover equalization levy or not. So that is one set of questions which also needs to be answered, which has not yet been thought through. And I believe that even the unified approach, if it at all, it does sort of lead towards levy of equalization levy, which it does not seem it will, because it is leaning towards the new taxing rights, which is needed to be arrived at in terms of determining the non-routine profit to be distributed among these three types of jurisdiction, the three types of business source jurisdictions. So therefore, in terms of that being finalized, it would seem that equalization levy, once that is finalized, will have to go. But at this point in time, yes, it is there, but it just shows the sort of desperation of the Indian Tax Revenue Department to try and capture a huge source of revenue, which they believe is remaining outside the tax net in India. So whether it is right or wrong, we are not to say which is right or wrong. What we want to ensure is that India should not behave eventually in a manner that it is singled out and in a manner that it is dispelling or refusing people to come and do business in India. You talked about the attribution, and Professor Maisto talked about the depreciation for capital equipment and research and development and all of that. We've already seen in India, even under the permanent establishment attribution, a lot of cases we have seen are not allowing those expenses to be deducted for the purposes of attributing the global profit to an Indian permanent establishment. And we have those cases still pending in litigation, even as far as up to Supreme Court. So yes, these are the situations where India is trying to tax a particular set of economy, which India does believe is going to grow. But what it does seem to me is that there is some sort of a disconnect between what India should want to do and what India should be doing, is doing. And in the process, India is creating a huge amount of tax litigation, which can and should be avoided. Similarly, and I've already alluded to the fact that it's going to be very, very difficult to implement the levy of implement the equalization levy. Similarly, SCP, we have not yet operationalized, and I hope we do not operationalize it until the report is finalized, because India is looking more towards the revenue which is coming in a traditional manner allocated to a physical presence. So it is looking towards that, whereas unified approach is looking at the non-routine profit which is going to be allocated. So there does seem to be a discord between what India is looking at and what the OECD is coming out with. And my very humble and very relevant suggestion to the Indian tax policy developers is that India should move beyond the narrow concept of taxing everything. Let the economy grow, let the transactions grow. We will benefit from the Laffer curve. Let us do it in a more expansive manner than in a more restrictive manner. So my short answer to your question is that while what India has done seems to be within the broad framework of the unified approach, I believe that it is not in tune with what the development is. And I do believe that India will have to retrace or at least not go ahead with this kind of levy once the unified approach is finalized?
Yes.
Thanks, Daksha. Yeah, thanks a lot.
May comment?
Yes,
comment?
yes, of course, Professor Maisto. Please go ahead.
No, I believe that I'm not familiar. I'm not very familiar with the Indian equalization tax, but I learned basically today how it is structured, and I think when the question was raised on whether it can override treaties, namely if it fits into tax treaty or not. We had a similar debate in Europe when the European Commission proposed a digital service tax, which was designed and drafted in a way which is similar, I believe, to your equalization tax. And the debate that we had in Europe, as you probably know, that the digital service tax was not agreed by the member states of the European Union. We had precisely the same debate, namely whether such digital service tax would basically be stopped by double taxation agreements, as all agreements provide for business profits to be subject to tax in the source state to the extent that there is a permanent establishment. And personally, I expressed the view that the digital service tax, and I would say that could apply also to your equalization tax, falls under the scope of tax treaties, basically for two reasons. First, it is based on turnover, but it approximates the income that might be considered to be attributable to the source state. So it's more or less like taxation in the extractive industry, where you don't have taxation on the net profits, but you have taxation on the turnover. And it is not a coincidence that countries which have introduced an equalization tax shall stop that equalization tax as soon as the OECD shall reach an agreement on Pillar 1 and Pillar 2, which basically are related to business profits and to income taxes. So if you stop an equalization tax, which governments pretend to be an indirect tax, if you stop that when you have an agreement on allocation of income taxes, that is the clear evidence that the digital service tax or the equalization tax is a tax on income. Second, it is levied on the company, not on the consumers. That is another element which indicates that the equalization tax in general, I'm not talking about India particularly, most likely it to be regarded a tax covered by the treaty. For your information, when the proposal was submitted to the European Council, the legal service of the European Council expressed indeed doubts about that tax not to be covered by tax treaties. It seemed to indicate that the legal service of the Council of the European Union seems to take a position similar to the one that I have mentioned, namely that the equalization tax is covered by tax treaties and is prevented by tax treaties. Obviously, governments, when they propose and introduce a tax like that, necessarily they need to say and to argue that it is not covered by a treaty. Otherwise, it would never apply, because you would need to change treaties before you have an equalization tax in place. So that was my comment on the Daksha comment.
Yeah, sure. Thanks, Professor Maisto. I think
one comment here quickly, Parul. Sorry for interruption. I think one angle from which we need to look at equalization levy is whether that could fall within the concept of similar taxes because under the treaty. And the reason is that the way in which the tax treaties apply to the taxes that are in the nature of income tax, etc., and or similar taxes. And one thing we need to explore is that can we, even though it is not part of income tax, can we still classify the similar taxes and therefore covered by the tax treaty in absence of permanent restoration? Otherwise, it may not be taxed. I think I thought I just intervened and just for the question, but we'll move forward.
Right. And I think even in OECD's report, while, equalization levy was one of the ways in which, the digital tax could be levied. And OECD had also mentioned that, if countries are going to decide to, put in an equalization levy, then they should do it in a manner that tax treaty obligations are respected. But Dhruv, I think, you had some viewpoint on the applicability of treaties to equalization levy. So, why don't you talk about it?
Sure, thank you very much. Actually, Nishith Bhai sort of stole my thunder. In fact,
Sorry.
No, it's all right. I'm just joking. No, not exactly, but it's a very valid point because Article 2, Paragraph 4 of the OECD model, which I've gone through each and every treaty that India has entered into, it has exactly the same provision which says this convention shall apply to an identical or substantially similar tax that is imposed after the date of signature. What is also very important to note over here is also paragraph 1. It says, this convention shall apply to taxes on income and on capital imposed on behalf of the contracting state or of its political subdivisions or local authorities. One of the arguments that has been raised in order to deny that equalization levy sort of falls within the scope of tax treaties is the geographical scope of the equalization levy being different than that of the Income Tax Act. The Income Tax Act, as you know, does not apply to the state of Jammu and Kashmir, whereas the Finance Act in itself applies to the entirety of India, the equalization levy within the Finance Act. This is because the taxes are levied under different entries of the 7th schedule in the Constitution of India. Now, they say that because the geographical scope of the equalization levy is broader than that of the Indian Income Tax Act, they're not substantially similar taxes. This is the argument which has also been stated in the CBDT's discussion draft. What is really surprising is when you are talking about taxes which are imposed on behalf of a contracting state or of its political subdivision, I would think a state is a political subdivision. So if a state tax is covered by a tax treaty, I would imagine that a tax which is levied in a multiplicity of states bar one should also be a similar tax to one which is levied throughout the geography of India. So I think these sorts of arguments that have been raised by the CBDT appear to be a bit specious and skating on.
I'll just make one point here, Nishith here, and particularly in the context of the U.S. taxation. I have to check on that. But, I remember that under the U.S. tax code, foreign tax credit is available provided foreign tax is income tax, and as the concept under the U.S. law is understood. So would this fall under the U.S. Concept of income tax is another thing. There is a famous case, I think, Maisto, that Italian bonds case long ago, where Italy imposed a 1 or 2% or some percent tax on the value of the bonds and as an income tax. And in the US, they say that no, this is not an income tax as understood within or in the US, and therefore tax credit would not be available. So, you might recall that famous case long ago. It was, maybe 30 years ago. So foreign tax has to fall within the concept of the income tax in the US. And I think, Maisto, if you have some thought on that, but most of the tech companies are from the US, and how would it possibly unfold is something to be, look at. Parul, will extend the session a little bit because we have stalwart and we want the benefit of people like Daksha and Maisto and others here all the time. So
but before Professor Maisto answers that, I think I just wanted to extend that question. And, this has relevance to the manner in which the calculation, is stated to happen as per the Pillar 1 report. Professor Maisto explained how the, amount A allocation happens, which is basically the allocation of the residual profits of the entity which is owning the intangibles. And the question is, Professor Maisto, we are looking at a situation where there may be difficulty in obtaining tax credits, like, Nishith Bhai explained, because of, certain domestic law constraints. There could be a difficulty in obtaining tax credits because of triangular situations. There could be users or sales that could be happening in multiple jurisdictions. And there could also be some sort of a double taxation, when allocation of profits happens under amount A and amount C. Amount C is, basically the amount which gets allocated for activities which exceed the routine marketing and distribution activities. And while, I think at least, in India, we have the, the AMP controversy going on, and, it will be good to see what approach OECD comes out with respect to the allocation to amount C. But Professor Maisto, it would be good to get your thoughts on, there are these different ways where, there would be some sort of a double taxation, either double taxation of the income or, there's failure to obtain credits in different jurisdictions. What do you think really, is the approach that should be followed for providing appropriate relief? And what work further needs to be done by OECD in order to ensure that, this Pillar 1 doesn't really result in more disputes rather than simplification? And I'm sorry if that's a really long question.
No, thank you. Thank you. Well, I think that avoidance of double taxation is indeed one additional issue raised by the structure of Pillar 1 and the breakdown in the three different amounts. And first of all, I would say that if we look at double taxation, I think we have two problems. The first one is taxes levied at source already, and taxes which would continue to be levied at source, putting aside the application of the Pillar 1, situations in which you have a permanent establishment and the taxes levied in the source state of a permanent establishment would need to be taken into account and deducted from the taxes due under the Pillar 1 approach in order to avoid double taxation. Then you may have withholding taxes levied on royalties, especially when the royalties are related to some of the functions which are included in the Pillar 1 allocation. Those taxes will need to be taken into account and also deducted from the overall tax levied under the Pillar 1 approach in order to basically avoid double taxation. You may have issues of double taxation also regardless of the allocation itself, to the extent that the taxable persons are not properly identified. The Pillar 1 always makes reference to groups, to multinational companies which are in the business facing consumers. So they provide a key for allocating income within the group. But there is no reference to who is going to be the taxable person within the group, because in many countries, a group is not a taxable person. You need a legal entity to be the taxable person. So if the source state is to apply the tax to the group, but in the resident state, the tax may be levied only on a legal entity, then you may have inconsistencies between the entity which suffered the tax in the source state and the entity which may be a taxable person in the resident state. That is something that, in my view, would basically need to be addressed properly, taking into consideration also situations in which you have transparent entities in between, so that in group X you may conduct the business in a particular country through a transparent entity, and obviously you may have characterization issues as to who is going to declare the income attributable to the transparent entity, and you need a consistency between source and resident states, or situations in which the group or the entity belonging to the group does have a consolidation, tax consolidation within the country. That also would require rules for some consistency. Something which I wanted to add, which is unrelated to a little bit to your question, but I would like to mention that because it was addressed in the presentation of Daksha. It's about excluded businesses, and that also may be cause for reason for double taxation, depending on the convergence of countries on the meaning of a certain excluded business. You mentioned shipping income from shipping transportation, but I agree, and I have made that comment also in my paper, namely that the income is excluded from Pillar 1 because of Article 8 of the OECD model takes a clear view that shipping and aircraft income should be left out from source taxing rights in order not to create impediments to international transportation. But even if one were to consider that, we should take into consideration that in many countries we have a tonnage tax. So a special way of levying taxes on income from shipping, which again would need to be coordinated if one were to include that business in Pillar 1. The excluded businesses may create lots of problems. Obviously, there is a lot of lobbying about it, but also good reasons to include or exclude. For example, one of the businesses which have been said to be ruled out from Pillar 1 are businesses which don't really face consumers so much, such as the pharma business, some of the pharma business, for instance, or businesses which are regulated. It was mentioned by Daksha about banking insurance. Although we have part of a banking business is related to consumers, is private banking services, so those should reasonably be included in Pillar 1. So excluded businesses also is something which might be a reason for double taxation if there is no agreement on a case-by-case basis about what is an excluded business or not.
Thank you, Professor Maisto. I think just moving on to, to the next question. We talked about what may be the excluded businesses and how, it may be difficult, at least in the US, to claim a foreign tax credit, and there could be issues arising from double taxation. But then the natural question that comes from there is, what is the solution? Are dispute resolution mechanisms sufficient to tackle the type of disputes which may arise because of the Pillar 1 approach? And are we really looking at some sort of a multilateral dispute resolution kind of a treaty, rely more on multilateral APAs? And Professor Maisto, while you answer that question, probably Daksha, you can also give your comments, given the, where the APA program in India has reached. What really needs to be done in order to make dispute resolution more effective in the international context, also given that India has not signed up to mandatory binding arbitration, given the issue around sovereignty. So Professor Maisto, to you, and then, Daksha, probably your comments on this.
Thank you. I think that, yes, multilateral arbitration, Pillar 1 is a multilateral, let's say, allocation system. I don't think we can have a bilateralism in Pillar 1. So necessarily, I think that arbitration is most likely the only way to avoid double taxation. And perhaps in addition to something which we have experienced already, certainly in Europe, the ICAP, the International Compliance Assurance Program, so to multilateral audit, let's say, coordinated between countries, and that would be a way to anticipate issues of double taxation, just to basically step in at the time tax returns have to be, let's say, prepared and allocation has to be made. But obviously is a huge and long process, and arbitration seems to me too early to think of a multilateral arbitration system. And the reason is that if you look at the policy of countries under the multilateral convention, the BEPS multilateral convention, section 6 of the multilateral convention dealing with arbitration, if you look at how many countries have elected for arbitration, you don't have 90 countries. You have much less than all the countries covered by the multilateral convention. So in other words, we continue to see resistance to arbitration by some countries, and even countries which have accepted arbitration, they do like to exclude certain areas of dispute from arbitration. And so to think of a multilateral arbitration system is something which is not, we are not yet at a mature stage for having such a multilateral arbitration, which will be the solution for the Pillar 1.
Just a small intervention. Sorry, go ahead. And Parul, can I make a statement?
Yeah, sure, Nishith.
We are lucky to have, I think, many tech celebrities such as Akhilesh Ranjan and TP Oswald and David Rosenblum. We are running short of time, unfortunately, but I'm very happy about it. Now, one small thing, I think David has important comment. I don't know whether he can be unmuted or not, but maybe you can read his comment. David, can you try unmuting, and does it work? I don't know, Mukesh can help. Because it's a US thing.
I think he's left the chat already. Otherwise, connection problem or so.
Okay, no problem. But you can talk if you want to. Or, I don't know, Akhilesh is also there, If you're small, anyone. Can you unmute, TP? No, I think somebody, I don't know. Anyway, I think we can move forward. And thank you, Akhilesh. I think interesting comment. Parul, you may want to just read out Akhilesh's comment and David Rosenblum's, and we can move forward. I don't know if everybody can see their comments. It's very nice to have them,
Thank you.
Sure. So I think Professor Rosenblum has commented saying that it is very dubious that there would be a foreign tax credit for such a tax. And even if the tax is creditable, the source of the income is probably not foreign under our rules. He means the US rules. And also the limitation on the credit is very low with the 21% corporate rate. So I think, he's agreeing to the conversation that, it may be difficult. I think, Nishith Bhai, you brought over that point. It may be difficult to claim a credit in the US. And that's what he's talking about. Daksha, over to you on, your comments with respect to dispute resolution. I think we are just quickly running out of time. So please.
Yeah, so I'll just be very brief about it. I would just like to talk about one fact that, Professor Maisto referred to that the entity which actually needs to claim credit or entity which is going to be subjected to tax because of this arriving at non-routine profit on the basis of the global accounts, financial statements, may just be a different country, a different entity than the entity which is actually doing business in the source country, which means that it may also be difficult to sort of, arrive at which treaties and which country it is that is going to have to subject itself to this arbitration. So while India has been very confident about its ability to do a mutual agreement process, it has a lot of faith in that. I don't doubt it. If Mr. Akhilesh Ranjan is there, he and we have talked about it also earlier, that this is one thing where we do have some sort of a concern, but India is confident that they can go ahead and do it. But it may just be too difficult to pin down which two jurisdictions are going to do it. It may be that there are going to be more than one jurisdiction which need to get involved in terms of resolving this issue. And as a result of that, I do believe that arbitration would be the answer, and we will need to move towards finding solution in terms of that if we are really looking at an economy which is going to be majorly moving towards digital transactions.
Yeah. Thanks a lot, Daksha, for those valuable comments. I think from my side, and for all the participants who are from India, and actually even, not from India, what we can really expect to see in the near future with, and with given that OECD is keen on keeping up its commitment for 2020, is, changes to the Indian Income Tax Act to align with the unified approach. Tax treaties cannot really create taxing rights which are not present in domestic law. So it would be quite interesting to see how the income tax law is changed further, and specifically considering that, EL and SCP coexist. Of course, there won't be an EL if there is an SCP, but that is something to watch out for. What I would also like to see probably is, revising threshold level where Indian tax is concerned. Currently, equalization levy is, it's levied at very low threshold amounts, and they don't even compare to the thresholds which are being talked about in the unified approach in the Pillar 1. The new equalization levy is, that's levied where the transaction amount is north of $250,000, whereas, OECD is talking about, following the kind of a CBCR approach Of course, one can say that the two are not, it's not really an apple-to-apple comparison, but it would be good to see what threshold limits are set in the future for taxation. And last but not the least, at least, there needs to be some clarity with respect to the new equalization levy on, who all really get covered. I think the way the provisions are worded, they are open to multiple levels of interpretation. There's a question of constitutionality. Is there really sufficient nexus which is created with India? And does it really tie in with the economic nexus that is being talked about? I think those are questions that still need to be answered. But I would really like to thank all the panelists for sharing their wisdom with all of us. We've learned a lot. And of course, to Nishith Bhai for, starting from the 2002 report. And Nishith Bhai, would be great to, have your closing comments. Please, if you could help in closing the session.
Well, thank you so much. And I see Mr. T.P. Oswal also just chatted on the chat box. Very lucky to have you. So anyway, let me then conclude in a minute or so. First of all, a wonderful session. We all recognize the problems that the digital economy has really caused. And it's going to be more and more difficult because everything is in the cloud, as I mentioned earlier. And clouds also move from country to country. You don't know, you can't even identify the same cloud or different cloud. So everything is going to go into cloud. And in the process, source, residence, the taxability and stuff like that is going to be more trickier. And of course, more and more countries may want to extend their extend their taxing right to other jurisdictions where they have taxing rights or not. So what I call some kind of tax imperialism may set in. We don't know. But what I would really want to do, and that is what we are going to do on Monday, May 4th, I will set out my vision for one world, one tax. We would also have Mr. Arvind Datar that day talking about constitutionality in the context of taxation, mostly international tax and nexus and stuff like that. And Poras Kaka has also confirmed to me that he would be excited to join the debate. So Monday on 4th May, I will have a very interesting dialogue on can we find a solution? Because all that we have done so far is to talk about the problems and of course the potential solution, but I think ultimately somewhere on the line we'll have to get into new tax world, and I would be happy to be talking on one world, one tax concept. I'm also delighted, and I had really, we've done so many things, Daksha, exciting in 2002, and so the expert report, I was just revisiting that after reading your, because I'd just forgotten about too much, because I keep on doing something or the other. And I see I must acknowledge your contribution to that report, and thank you so much, Parul. Wonderful to have you, and moderating this panel. It's been very nice, and thank you everyone who has joined on this WebEx, and continue our discussion on other subjects tomorrow and the day after, and so on and so forth. So most welcome. Thank you so much.